The Great Substitution, Gold, BRICS, and the End of Dollar Dominance. Summary statement. As trust in U.S. Treasuries erodes and the Global South accelerates its break from dollar hegemony, gold is undergoing a structural revaluation, quietly reemerging as the global settlement asset of choice. Backed by rising BRICS reserves and a wave of tokenized monetary infrastructure, this transition mirrors the 1970s petrodollar strategy in reverse. Just as the U.S. once inflated oil prices to create artificial demand for dollars, today's commodity powers are driving up the price of gold to build a neutral, collateral-backed trade system that bypasses U.S. control. This is not a collapse. It's a substitution, and it's already underway. Introduction. The unseen reset. History rarely announces itself with fanfare. There's no press release when an empire begins to lose its grip. No buzzer that sounds when a new monetary order quietly takes hold. Instead, things shift silently. Settlements change hands in different units. Reserves move from promise to wait. New pipes get laid underground, until one day, the old channels run dry. This is where we are now, not at a moment of collapse, but at the dawn of substitution. The U.S. Treasury market, once the unrivaled cornerstone of global trade and savings, still stands at roughly $29 trillion in marketable securities. But beneath its surface, trust is leaking fast. Sanctions, yield volatility, politicized monetary policy, and unsustainable deficits have shaken confidence across the global South. Meanwhile, something ancient is being reborn. Gold, the inert metal long dismissed by Wall Street as a barbarous relic, has quietly surged. In 2025 alone, it added $5.5 trillion in market capitalization, bringing its total valuation to $25.9 trillion, now within striking distance of the Treasury market itself. This exposition explores what that revaluation means. We're not just watching a price movement, we're witnessing a geopolitical recalibration where gold is positioned to replace treasuries as the neutral, non-politicized base layer for global settlement. It's not theoretical, it's happening. And it echoes something we've seen before, just in reverse. Historical parallel. How the dollar took the throne. To understand what's happening now, you have to understand what happened then, when the U.S. dollar became more than just a currency. It became the denominator of the entire global economy. The turning point came in 1971, when President Richard Nixon closed the gold window, severing the dollar's direct convertibility to gold. This broke the Bretton Woods system, which had pegged global currencies to the dollar, and the dollar to gold. The immediate consequence? The world no longer had a neutral settlement asset. Fiat replaced collateral. But the U.S. had a problem. If dollars were no longer backed by gold, what would compel the world to keep holding and using them? The answer came in 1974, engineered by Henry Kissinger. The oil gambit. In a now infamous realignment, Kissinger brokered a deal with Saudi Arabia. The U.S. would provide military protection and technological support. In return, Saudi oil would be priced exclusively in U.S. dollars. OPEC would follow suit. Surplus revenues, petrodollars, would be recycled into U.S. Treasury debt. But there was a catch. For the system to work, there had to be enough dollar demand. And so, according to later interviews with Saudi oil minister Ahmed Zaki Yamani, Kissinger signaled that oil prices would rise dramatically, by 400%, creating the scale needed to make petrodollar recycling viable. The price of oil is going up 400%. Get on board. Yamani, recounting Kissinger's warning at a 1973 Bilderberg meeting. The result? A global artificial demand for U.S. dollars, enforced through energy markets. Nations needed dollars to buy oil, and once they had them, they recycled those dollars back into treasuries to earn interest. This became the foundation of U.S. fiscal dominance for the next 50 years. Dollar demand equals oil demand. Oil demand equals global trade. Global trade equals U.S. treasuries as world reserve. It was a brilliant piece of monetary jujitsu. The U.S. turned oil into the new backing for its currency and treasuries into the global piggy bank. A world that once saved in gold now saved in debt because the system offered no alternative until now. Section 3. Present day, a new settlement layer emerges. Fast forward to 2025, and the foundation that supported dollar dominance is cracking. The machinery that once recycled petrodollars into U.S. treasuries is seizing up. Not because of a catastrophic breakdown, because key players have quietly exited the game. Saudi Arabia has begun settling oil trades in yuan, rupees, and dirhams. China and Russia are transacting in local currencies. BRICS plus nations are reducing U.S. Treasury holdings and increasing gold reserves at a record pace. Central banks bought over 2,100 tons of gold in 2022 and 2023 alone, a post-Bretton Woods record. This is not a hedge. This is a pivot. And now the numbers tell the story. Gold's 2025 repricing, the silent shock. In just 1 year, gold has added $5.5 trillion to its market cap. At a price of $3,300, the total above-ground gold supply, 244,000 metric tons, is now worth $25.9 trillion. This figure is within striking distance of the $29 trillion U.S. Treasury market. This isn't just symbolic parity, it's functional. Gold, once deemed too small to replace treasuries, is now large enough to do the job. Just as the U.S. engineered a 400% increase in oil prices to force dollar demand in the 1970s, the 2025 gold repricing achieves the same scale, but this time in reverse. Instead of inflating energy to support fiat debt, BRICS appears to be inflating gold to support neutral settlement. The infrastructure that makes it possible. This isn't just about shiny metal in a vault, it's about monetary plumbing, and the pipes are already being laid. Tokenized gold instruments like Tether Gold and other CBDC collateralized ledgers are proving that gold can move at the speed of code, not ships. mBridge, a cross-border CBDC settlement project involving China, UAE, Hong Kong, and Thailand, is live testing interoperable digital currency transactions, potentially backed by real assets like gold. CIPS, China's SWIFT alternative, is growing steadily, handling hundreds of billions in cross-border yuan flows. In short, the Global South isn't just talking about de-dollarization. It's rebuilding the trade stack from the base layer up with gold as the root collateral. Gold is no longer a passive reserve. It is being activated. Next section, deconstructing the fiat defenses. Western economists and financial media have long dismissed gold's return as unworkable, not because it isn't trusted, but because they claim it isn't functional. The arguments come dressed in complex jargon, but they boil down to 4 main critiques. 1, gold lacks liquidity. 2, gold doesn't yield interest. 3, gold lacks modern infrastructure. 4, BRICS is too fragmented to coordinate around gold. Let's dismantle each of these defenses, not from the perspective of Wall Street, but from the real world of goods, trade, and sovereignty. 1, the liquidity myth. Treasuries are more liquid. They trade $900 billion a day. Gold only trades $100 to $150 billion. So what? Liquidity is a speculator's metric, not a sovereign's concern. Nations aren't flipping treasuries like day traders. They're settling balances, clearing accounts, and securing reserves. They care about reliability, not intraday trading volume. And with the rise of automated settlement rails, blockchains, smart contracts, CBDCs, the need for high-frequency intermediated liquidity is fading fast. The dollar-centric system was built for brokers. The gold system being built now is built for builders. 2, the yield illusion. Gold doesn't pay interest, treasuries do. Yes, and that interest is paid in newly printed money. Treasury yield is a synthetic reward to compensate for the risk of holding an inflating asset. It's the fiat version of staking rewards in crypto, paying holders to sit tight while their share of the pie shrinks. Gold doesn't yield because it doesn't dilute. In fact, the lesson from crypto is clear. Non-yielding, hard-capped assets outperform yield-bearing inflationary systems in the long run. Bitcoin taught this to a new generation. Now gold is teaching it to the world's central banks. 3, the infrastructure lie. Gold lacks the infrastructure for global settlement. False. The BRICS bloc and its allies are building parallel financial systems in real time. mBridge for cross-border digital currency settlement. CIPS as a SWIFT alternative. BRICS Bridge for unified payment corridors. Tokenized gold running on Ethereum, Tron, and private ledgers. These aren't experiments. They're operational and they're growing. Gold is no longer a rock in a vault. It's a programmable monetary primitive. 4, the fragmentation fallacy. BRICS can't coordinate. They're too diverse. They don't need to unify politically. They only need to align economically. The goal is not one currency or one bank. The goal is a network of trade corridors, powered by neutral settlement, free from U.S. coercion. That's already happening. India, Russia trades in rupees and rubles. China, Iran settles in yuan. UAE, Africa explores gold-pegged digital trade. It's a modular system, not centralized, not fragile, and exactly what's needed in a multipolar world. These so-called flaws of gold are only flaws if your goal is to preserve the U.S. financial empire. If your goal is to trade fairly, settle securely, and build sovereign trust, they're features. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Next section, V, the new trade terrain. The terrain is shifting and fast. For decades, the U.S. dollar acted as the global middleman. You couldn't settle large-scale trade without it. You couldn't park your reserves in anything else. Treasuries were the universal lubricant. But that was a feature of monopoly, not of necessity. And now, with BRICS and the Global South building new corridors, the global economy is discovering it doesn't need the dollar middleman anymore. The numbers don't lie. Let's get practical. Annual global trade, goods plus services, $32 to $34 trillion. BRICS trade volume among members and aligned countries, 10 to 12 trillion. Collateral typically required to support this trade, 10 to 20%, $1 to $4 trillion. Gold market cap at $3,300, $25.9 trillion. This means that even a fraction of gold's value is more than enough to underwrite the entire BRICS trade system, and then some. BRICS doesn't need to replace the entire dollar system overnight. It just needs to build a parallel one that works for them. That's happening now. The new rail's in motion. Here's what's being quietly deployed. mBridge, a live CBDC settlement system used by China, Thailand, UAE, and Hong Kong, now expanding to other Global South nations. CIPS, China's yuan-based alternative to SWIFT, with expanding usage across Asia, Africa, and the Middle East. Digital gold instruments like Tether Gold or institutional vault-backed tokens, allowing gold to be instantly settled, fractionally used, and digitally audited. BRICS Bridge, a proposed settlement network that doesn't need a single currency, just trusted rails plus shared standards. This is not an abstract idea. This is monetary infrastructure deployment at a scale and speed that no one in Washington or Brussels expected. What's being built is simple but profound. Hard collateral, gold commodities, programmable rails, CBDCs, tokenized assets, neutral pricing, local currencies or new units, non-coercive alignment, voluntary trade blocks, not forced military pacts. It's not globalism. It's localism scaled. A world where countries don't need to bend the knee to access the global economy. And the key that unlocks this new terrain? Gold, not as a relic, but as a root layer. Next section, strategic implications, the end of dollar dominance. The U.S. dollar's role as the world's reserve currency was never about ideology. It was about infrastructure. It offered three things no one else could. 1, a neutral unit of account. 2, a safe asset to store global savings. And 3, the deepest, most liquid markets for collateral and trade settlement. But now all three pillars are eroding. Treasuries are no longer safe. The U.S. Treasury market, once the envy of the world, is showing structural cracks. Foreign holdings of treasuries are in multi-year decline. China alone sold $53.3 billion in early 2024. Yields are rising, not because of growth, but because of vanishing demand. The U.S. debt spiral is feeding on itself. More debt issuance, higher interest expense, more issuance, rinse and repeat. In a world where demand for treasuries is no longer guaranteed, the U.S. must either raise rates to attract buyers or print money to plug the gap. Either option is terminal. Higher rates equals collapse in asset prices. More printing equals dollar debasement. 2. The dollar's utility is being bypassed. For decades, countries used dollars because they had to, not because they wanted to. But that era is ending. Oil is now priced in multiple currencies. SWIFT is no longer the only channel. Trade corridors are forming based on regional logic, not U.S. approval. This changes everything. The dollar's greatest strength, network effects, is becoming its greatest vulnerability. Because once countries see they can trade without it, they won't go back. 3. Trust has collapsed. Quietly. The U.S. financial system isn't being abandoned because it failed economically. It's being abandoned because it failed politically. Weaponizing the dollar via sanctions, asset freezes, told sovereign nations one thing: your money isn't yours if we don't like your politics. Freezing Russia's reserves in 2022 was a seismic event, a loud warning to every non-aligned country. That's when the quiet gold accumulation began. That's when the rails started getting built. That's when the substitution began. This is not a crash. It's not a war. It's a rerouting. It's the slow, irreversible migration of trust from promises to weight. Section 7, conclusion. Gold didn't win, debt lost. This isn't a gold rush. It's a debt retreat. Gold didn't rise because it lobbied for trust. It rose because everything else burned it. The US dollar, once a symbol of strength, became a tool of coercion. Treasuries, once a global savings vehicle, became debt instruments feeding on artificial demand. The financial system, once a neutral arena, became a political battlefield. And in that vacuum, gold did what it always does. It waited. It didn't inflate. It didn't default. It didn't care who was in power. It just sat there, weighty and incorruptible, until the world remembered why it mattered. The shift we're seeing isn't loud. It's not a collapse. It's a great substitution from speculation to settlement, debt to collateral, yield to trust, dollar to gold. The BRICS nations aren't launching a revolution. They're launching an exit. They are not trying to replace the dollar with a new empire. They are replacing the empire model itself. One trade at a time, one vault at a time, one ledger at a time. The West, blinded by its own metrics, liquidity, yield, control, never imagined a world that could function without them. But that world is now emerging, quietly, competently, irreversibly. And so the question is no longer, will gold replace treasuries? The question is, what will you hold when promises no longer settle the trade?